All right. Thank you for joining this advanced financial management introductory session. My name is Lukman Rafiq, and I'm going to be conducting this AFM session for you people. We are going to start off with a June 2021 exam session. And we do have some of the students who wish to study for the September 2021 exam session also. So this is going to be an equally important session for them also. They can study with the students for the June 2021, and whatsoever are the amendments going to be, I am going to cover those amendments in the later part of this specific course. So before I start off with the advanced financial management, let's have a quick discussion about the syllabus relationship, the relational diagram of this specific paper, that what exactly are the papers with which this specific paper is connected or dependent. So as you know that there is a strong connection between the financial management paper, which is the F9, but there is some connection with the management accounting paper also, which is F2. And there's also some connection with the SBL paper, which was previously the P1 and P3 paper. So there is a strong connection with the P3 paper also. So if I talk about this advanced financial management, so if you are to study this advanced financial management, you should know this paper F9. It's okay even if you have not studied this SBL, you can still manage to pass the paper of this specific AFM without having sufficient knowledge of SBL also. So one thing is, it's important to have the F9 level knowledge. Now, what exactly are the F9 syllabus areas, and what were exactly were the F9 syllabus areas and how they are connected with this AFM syllabus areas? So that I'm going to guide you people with respect to it. When we talk about this F9, when we talk about the F9, few of the important areas that were examined at the F9 level, those areas included the working capital management. Number two, those areas included the investment appraisal. The third one of them was the sources of finance. The fourth one of them was the fourth one of them was the cost of capital. The fifth one of them was the capital structure theories. Then there was this business valuation. Then what you had at the F9 level was the risk management, which included both the currency and both the interest rate risk management, which included both the currency and which included both the interest rate risk management. Now let me guide you people that whatever that you have studied at the F9 level, except for this working capital management, I repeat, except for the working capital management, everything is examinable at this AFM level. I repeat, except for working capital management, everything is examinable at this AFM level. So now what exactly are the things that are examinable? So I'm going to take you people through the AFM syllabus and I'm going to compare them with the F9 things that you have already studied. So when we talk about, I repeat, when we talk about this AFM syllabus, you could see that there are different specific areas of the syllabus, including advanced investment appraisal, including the acquisitions and the mergers. And then you've got the corporate reconstruction and the corporate reorganization. Then you've got the treasury and the advanced risk management areas. Now let's just try to see what exactly are the areas and how are they connected to the F9 level. So whatever investment appraisal that you have studied at the F9 level, this whole entire investment appraisal is examinable at this AFM level also. And what we study over here is the advanced investment appraisal. So this investment appraisal is connected to the section B of the syllabus, which is about the advanced investment appraisal. So whatever investment appraisal that you have studied, it's connected to the advanced investment appraisal area. Now, what have we studied at the F9 level? So at the F9 level, we have studied this basic thing, which is called the concept of time value of money. We have studied the basic techniques of the accounting rate of return. We have studied the basic techniques of payback, the net present value, the IRR, and then what happens is lease or buy decision. We have also studied the capital rationing. All of this is something that you have studied at F9 level. So when it comes to AFM, except for this lease or buy, everything is examinable. Except for this lease or buy, everything is examinable. And it's not just going to be examinable, they are going to build up on the concepts that were actually taught at the F9 level, and you will be examined the advanced level. You would be examined the advanced level investment appraisal. You will be examined the advanced level investment appraisal. That is something that you will be tested at this AFM level. So whatever that you have studied at the F9, all of that is going to be examined. Along with this, there is going to be the advanced level concepts that are going to be examined. There's going to be advanced level concept that is going to be examined. Now, so what are these advanced level concept? Let me go through the advanced level concepts thing, that what are these advanced level concept going to be. Now, when I talk about this advanced level concepts, so the advanced level concepts are going to be, you will have the multiple things which would include the adjusted present value technique. There is a technique which is called adjusted present value. There's going to be a technique which is going to be the modified internal rate of return. And there are going to be other things which include the option pricing model, etc., etc., etc. So there are going to be multiple things that are going to be examined. So advanced investment appraisal is an important area of the syllabus, and it constitutes approximately 30% of what is examined to you people. So 30% of whatever that is examined at AFM level, that includes the advanced investment appraisal. Now, if I move a bit forward, the next aspect of this specific syllabus of the AFM is the acquisition and merger. At the F9 level, we have already studied the business valuations. So what is actually going to be examined over here at this AFM level is that you'll be discussing this mergers and acquisition. And while discussing the mergers and acquisition, not only the valuation technique that you have studied at F9 that is going to be examined, and other non-financial aspects that you cover while considering any specific merger acquisition, the method of financing the mergers and acquisition, the different type of synergies that are expected to arise out of mergers and acquisition. So all of that is going to be considered. So when we'll be discussing this mergers and acquisition at the AFM level, again, it's an important area. So it could constitute 25% of the syllabus. Like what happens is in any of the attempt, I'm sharing my past experience in any of these attempts. What actually happens is either of these areas is examined for 25 marks. This is approximately 30% of the syllabus. So in either of these attempts, it's either going to be 25% from acquisition merger or corporate reconstruction or reorganization. Or even what you could do is that you could say that these three areas are going to constitute approximately 50% of the syllabus. So any two questions from any of these areas, at times it could actually be a mixture also of section C, section D, and section E of the syllabus. So whatever we have studied from the valuation perspective, that is going to be applicable at the mergers and acquisition. Whatever investment appraisal that you have studied, that is going to be applicable at the advanced investment appraisal area. If I move a bit forward and if I discuss further, the next area is about the corporate reconstruction and reorganization. So all of the areas of this sources of finance, then at the same time the cost of capital, the capital structure theories, etc., etc. All of this is going to be applicable on this specific corporate reconstruction and corporate reorganization. What exactly do you mean by this corporate reconstruction and reorganization? So let's try to have a discussion of this corporate reconstruction and reorganization. Generally speaking, what happens is you at times bring about a change in how your business's financial structure is. Maybe you are right now 100% equity funded company. You might want to take up some of the debt. Let's say you want to take up 20% debt. Maybe you want to convert some debt to equity. Maybe you want to convert some equity to debt. Maybe you want to issue new type of instruments, etc., etc., etc. So all of this is going to be bringing about a change to the financial structure of the entity. And if you wish to bring about a change to the financial structure of the entity, that is actually going to be considered as what? I repeat, that is actually going to be considered as, I repeat, if you wish to bring about a change to the financial structure of the entity, that is going to be considered as a reconstruction, and this reconstruction is going to be examined over here. So the corporate reconstruction and reorganization, that's an important area, that how do an entity brings about a change in the entity's financial structure. Okay, now what next is there? The next situation is that, I repeat, the next situation is that, yeah, the shares buyback is also part of the capital structure and the reorganization. The next situation is about the treasury and advanced risk management technique. So whatever risk management that you have studied at the F9 level, it is actually going to be examinable here. I repeat, whatever the risk management that you have studied at the F9 level, that is going to be examinable here also. So basically, in short, if I could just conclude, I can tell you people that what exactly is this AFM syllabus all about. You could see that it's a buildup of whatever that you have studied at the F9. Every single thing that you have studied at the F9 is going to be examined at this specific AFM level. Now, the question mark that arises is that, sir, we have forgotten what we studied at F9 FM. We've forgotten. Whatever that we studied, we have simply forgotten. Okay, don't worry. Because I know this thing that you have forgotten it. So whenever we are going to be discussing these topics, what we will be doing is, we will actually be going through, I repeat, what we will be doing is, we will actually be going through the F9 areas. We will be having a quick recall of this F9 areas. And after having a quick recall of the F9 areas, what we would do is that we would then jump on to the next areas of the syllabus. So you don't have to worry about it that you have forgotten the F9. What we will be doing is, when we will be going through this, when we'll be going through this, any specific area of the syllabus, we would initially be going through the F9 areas. And then what we would do is that we would then move on to the next area. Okay, so that is something that we'll do, and then we'll move on to the AFM area so that it makes it easy for you people to actually understand the things, because I do know this thing and I do understand this thing, that usually the students have forgotten all of these things. So we are going to go through all of these so that you can have a good idea. Now, one of the question before I move on to any of the topic, let me discuss the approach that I will adopt in order to teach this specific paper. Let me discuss the approach. Just wait a bit, please. Okay, what you have in front of you is that there is a website of a Scribbler. The name of that website is scribbleracademy.com. Once you log on to this specific website, there are basically various papers. So amongst the various subjects, this AFM English subject is there. And if you could see, don't go for this 180 lectures to be 180 hours. It's not the 180 hours course. It's basically like this. You see, even if the introductory lecture, it was of 37 minutes, it's one lecture. Then you've got the WAC area, which is going to be, let's say, 12 minutes, 25 minutes, 34 minutes, 7 minutes, etc. So this is not all going to be, I repeat, this is not all going to be something which you would say that it's 180 lectures. I think it would be hardly some 70, 75 hours. That is what it is going to be. So what we do is that we go for a blended learning, and the blended learning would actually mean what? The blended learning would actually mean that we will be going through a mixture of we'll be going through a mixture of live and recorded sessions. That is what we are going to be approaching the syllabus like. So this is what our approach is going to be. So how many classes would I be conducting? What is going to be my schedule? So from this mid of March, which is right now, till the end of April, we would have around 8 to 10 live sessions, approximately of 3 hours each, in which I would be going through various topics and their past papers. And in the last month, which is going to be the month of May, I will be having approximately 15 sessions. Each session is of approximately 2 to 3 hours. And again, those sessions are going to be covering the past examination questions of the various topics. Well, I'm just going to share the link to the website for you people, so that if you wish to go through, in fact, I would just share the relevant link of the course also, so that you could just see, Dolly. Okay, now, so we would have around 15 sessions in the month of May, and each session is going to be of 2-3 hours each. So that's going to be the past paper session. And for this time round, I will be changing my approach a bit. I will actually be going for the mock exams. I repeat, I will actually be going for the mock examination. That is something that I will do. So what you would have to do is that you would have to keep prepared that we will go for the mock, and there is going to be a mock review session also. So that's it for the introduction. Now what I'm going to do is I'll start moving on to one of the topics. And the topic that I'm going to start off with today is the treasury and the advanced risk management technique. That is something that I'm going to start off with. So in case if any one of you have got any questions, any queries, do let me know so that I can answer, or else I'm going to move forward. Okay, thank you for this, Naseem. The paper pattern is like this. There are actually two sections. We have got section A, where there's one question of 50 marks, and you've got section B, where you've got two questions of 25 marks each, which is going to make it 50 marks. Rather, the crash course is going to be started, let's say. You could join in these classes in the month of May, which are going to be purely exam focused classes. Okay, so what have we done? I've actually explained to you people that this is what the paper pattern is. So we have had a discussion about the syllabus of this AFM, And what I'm going to do now is that I'm now going to move on to one of the topics, and I'm going to discuss that topic now. Okay, so let's just start off with the risk management. And when we talk about the risk management, so try to understand this thing, that there are two aspects of your syllabus with respect to risk management. And what are those? One of them is termed as the interest rate risk management, and the other one of them is the currency risk management. So what happens is there are two aspects of your syllabus with respect to the risk management. One of them is the interest rate risk management, and the other one of them is considered as the currency risk management. Now, what exactly is this interest rate risk management? What exactly is going to be the currency risk management? So what I'll do is that I'll deal with them one by one. And my starting point is going to be the interest rate risk management. So when we talk about the concept of this interest rate risk, uh, let's try to have an understanding. Let's try to have a discussion about it. What actually happens is that think of a company who intends to borrow. Think of a company who intends to borrow in 3 months' time. What is happening right now is that this company wishes to borrow $1 million. And right now, which is the spot date, the market interest rates are 8%. Now, this company is actually facing a risk. This company is actually facing a risk that in 3 months' time from now, these interest rates might actually move up to 10%. So that means what is going to happen is that we are going to be having a loss. What is the loss that we will be having? We'll be having a loss of $1 million multiplied by 10% minus 8%, which is going to be what? Which is going to be 1 million into 2%. That is the loss that we will probably be incurring in case if the interest rate moves. So I repeat, what happens is, assume that a company wishes to borrow the funds in the future. And if it wishes to borrow the funds in the future, so what happens is if the interest rates are going to go up, this company is going to end up losing $20,000 in terms of interest payments. So what this company would wish to do is that this company would wish to hedge. This company would wish to hedge itself against the interest rate movement. Itself against the interest rate movement. That is what this company is going to do. So one of them is the interest rate risk management. What is this interest rate risk management? It's actually one of those activities which you undertake in order to protect yourself against the adverse movements in the interest rate. Now let's take another example. Assume that you are somebody who has invested $5 million in the T-bills. And these T-bills are going to mature. Your investment is going to mature in 2 months' time. And you don't see any investment opportunity for the next 12 months. So what you are planning is that you will invest this $5 million for 12 months time in 2 months time. So I repeat, what happens is you have somebody who has invested this $5 million in T-bills, and this T-bill is going to mature in 2 months time, and you don't see any investment opportunity for the next 12 months. So what you are planning is that you will invest this $5 million for the next 12 months once you receive them after the 2 months. Now, the deposit rates right now are, let's say, 7%. And what you are expecting is that in 2 months' time, these deposit rates might go down to 4%. So if these deposit rates are going to go down to 4%, so that means you will be losing out 3% on this $5 million. And if it is going to be 3% on this $5 million, so this is going to be approximately $150,000 of interest that you would be losing out. So what you would want to do is that you would want to enter into our transaction. You would enter into a hedging relationship where you could hedge yourself against the adverse movement in the interest rates. So basically what you could understand from here is that, I repeat, basically what you could understand from here is that Whether you are somebody who is a borrower or whether you are somebody who is a lender, both of you face a risk with respect to the interest rate. I repeat, both of you face a risk with respect to the interest rate. What is the risk that the borrower faces? The risk that the borrower faces is that the interest rates are going to go up. What is the risk that the lender faces? And the risk that he faces is that the interest rates are going to go down. So if you think from the perspective of both the borrowers and the lenders, so you would realize this thing that both the borrowers and the lenders are facing a risk and their risks are different. What is the risk? What is the difference in their risk? The risks are different, which is one of them is that the interest rates are increasing and the other one of them is the interest rates would decrease. So this is what is actually going to happen. But both of them are facing a risk and both of them would wish to hedge this adverse movement in the interest rate. So what we actually do is that we enter into the different hedging arrangements. We enter into a different hedging arrangements to hedge against, to hedge against adverse movements in interest rates from the perspective of both borrower, from the perspective of both lender. Now, what exactly are the different hedging techniques that we enter into? So we are going to discuss them one by one. Is everyone okay till now? Okay, now, so the first thing that we will be discussing with respect to the interest rate risk management is called the technique of forward rate agreement. I repeat, the first technique that we would be discussing with respect to the interest rate risk management is called the forward rate agreement, which is also termed as FRA. Now, what exactly is this forward rate agreement or the FRA? Let's just start discussing them. When we talk about the concept of FRA, FRA is an agreement. FRA is an agreement. It's an agreement in which entity fixes its interest rate on the future borrowings slash lendings, and the rate remains fixed even if there is a significant movement in the spot rates. So what is a forward rate agreement? A forward rate agreement is one of those agreements in which you fix your interest rate and your interest rate is being fixed on the future borrowings or the lendings, and the interest rate is fixed in such a manner that irrespective of whatever movements in the spot rate take place, your interest rate is going to remain the fixed. Now, what exactly do you mean by this? For you to be able to understand this, I'll give you an example. Assume that you are an entity and you are into a negotiations with, let's say, you are in negotiation with a Standard Chartered Bank to borrow $5 million for let's say 1 year's time. You wish to borrow the $5 million for 1 year time in 3 months. You are asking a Standard Chartered Bank that what is going to be the interest rate that you will charge us. The Standard Chartered Bank is telling you that, look, we are going to decide on borrowing date. We're going to decide on borrowing date what is going to be the rate, but we can tell you one thing, that the rate is going to be LIBOR plus 0.5%. It's going to be LIBOR plus 0.5%. So we don't know what is going to be the LIBOR, but we are going to pay you in this specific rate, which is LIBOR plus 0.5%. Now, you go to another bank, which is, let's say you go to Citibank, and you ask the Citibank that, can you lend us the money? can you lend us the money of $5 million for 1 year? So what Citibank does is that the Citibank says that we cannot lend you the money. We cannot let you borrow from us. We cannot lend. The best that we can do is that we can enter into a hedging relationship with you, where we could enter into a forward rate agreement with you of, let's say, 7% on this $5 million, 7% on this $5 million for 12 months. What does this forward rate agreement of 7% on $5 million for 12 months would mean? This would mean that Citibank is telling you that, look, in case if you actually borrow at 9%, the Citibank is going to reimburse 2% to you, so you will be standing at 7%. In case if you borrow at, let's say, in case if you borrow at 6.5%, you will pay 0.5% to Citibank. So ultimately you will stay at 7%. So I repeat, what is Citibank telling you? Citibank is telling you that, look, we cannot lend money to you, but we can enter into a forward rate agreement with you. And what exactly do you mean by entering into a forward rate agreement with you? We are entering into a forward rate agreement with you at 7%. This would mean that you borrow the money from a Standard Chartered as per whatever negotiations you are having with a Standard Chartered. In case if your borrowing is above 7%, let's say if it's 9%, we are going to reimburse this 2% to you. And so that you stand at 7%. If you borrow at 6.5%, you will pay us 0.5% and you will stand at again 7%. So in this whole relationship, what is happening is that we as an entity, what are we up to? We are actually hedging ourselves. And what is Citibank up to? Citibank is actually speculating. It wishes to gain the advantage of the interest rate movement. I repeat, it wishes to gain the advantage of the interest rate movement. So that is what the Citibank is doing. So an agreement of this sort is going to be termed as a forward rate agreement. I repeat, the agreement of this sort is going to be termed as a forward rate agreement. So if everyone is okay, so I can move forward. Let me know if you all are okay with this. So let's move a bit further and let's discuss further. So generally speaking, what happens is when we enter into a forward rate agreement, there is always going to be one party who would be hedging, and there's going to be one party who is going to be speculating. So resultingly what happens is if you gain, they are going to lose. If you lose, they are going to gain. So in one of the scenarios, I told you people that it was Citibank. It was basically when we were gaining 2%, Citibank was losing out 2%. When we were losing out 0.5%, Citibank was gaining 0.5%. That is what actually happened in this specific example. In one of the case, it's you who is winning this 2%, and Citi is losing out. It's here Citi is winning this 0.5%, and you are losing out. So resultingly, this is something that's going to happen with every single hedging technique, that one of the party is going to gain and the other is going to lose. One of them is going to lose and the other is going to gain. One of them would be hedging, the other one of them would be speculating. Now let's move a bit further and let's discuss further. I'm going to give you people an example of how the forward rate agreements are being quoted in the exchanges, how the forward rate agreements are being quoted, and how do you actually perform the workings on these forward rate agreements. Okay, so in order to understand this FRA, let's talk about, let's consider one of the example. Under this example, it says an entity wishes to borrow $4 million in 3 months' time. So what does the entity wishes to do? It wishes to borrow $4 million in 3 months' time. So this is the date now. What they wish to do is that in 3 months from now, they actually wish to borrow for a period of 6 months. For a period of what? For a period of 6 months. So what happens is you've got an entity which is actually going to be borrowing $4 million for a period of 6 months. It says the available FRA, the available forward rate agreements are as under. I repeat, it says the available FRA, the available forward rate agreement are as under. So you're being given the multiple FRAs 3-6, 6-9, 3-9, etc. etc. Now, what exactly do you mean by these different types of FRAs? You see, what happens is the FRAs, whenever they are being quoted, they're being quoted in terms of months. What do you mean by this? The FRA is always read like this. It's always read from now. 3 months from now, like 3-6 means the first transaction is going to be for 3 months from now, and the second transaction is going to be in 6 months from now. So what happens is if I say 3-6 FRA, what do you mean by this? This is the first transaction. This is going to be the second transaction. If I say 6-9, this would means now, and the first transaction is going to be in 6 months from now. The second transaction is going to be in 9 months from now. And if I say 3-9, it says that the first transaction is going to be in 3 months from now, and the second transaction is going to be in 9 months from now. So always remember what happens is this FRA, it could be written as like 3-6, it could have been written as 3V6. What do you mean by this? This means that the first transaction takes place in 3 months, the second transaction takes place in 6 months from now. So if I could just have a look at this specific scenario, it says that the entity wishes to borrow $4 million in 3 months. Okay, so the first transaction is in 3 months. Time for a period of 6 months. For a period of 6 months. So if I say for a period of 6 months, so 3 plus 6 gives you 9. So the relevant FRA is going to be 3-9. This is going to be the relevant FRA. Why? Because the first transaction is happening in 3 months from now, and the second transaction is happening in 9 months from now. So the relevant FRA is going to be 3-9. Is that okay to you people? So the relevant FRA is going to be 3-9. Now, what is going to be the relevant percentage that we are going to be looking at? So if you wish to be looking at the relevant percentage, always remember that the lower percentage, I repeat, always remember that this lower percentage is going to be for the lender, and this higher percentage is going to be for the borrower. So that means what is happening is that, I repeat, what is happening is that you are borrowing $4 million. So this higher percentage is going to be applicable upon you. I repeat, this higher percentage is going to be applicable upon you. That means what you have done is you have obtained 3-9 relevant FRA with a 6.75%. You have got 3.3-9 FRA with a 6.75%. Is that okay now? That how do we actually establish the relevant FRA? Yeah, is that okay to you people now? That how do we establish the relevant FRA? So in order to establish the relevant FRA, what you need to do is that you need to see what are the transactions that are happening from now. I mean, like the time is always counted from now. That how many months from now and for the first transaction, and how many months from now for the second transaction. Okay, let's move a bit forward and let's discuss further. So 3-9 is the relevant FRA with a 6.75%. Now what next is there? For example, if the actual borrowing, now how would we actually do the calculations for FRA? How would we do the calculations for the FRA? So one of them is the spot rate is going to be what we are being told 7.3%, and the other case is the spot rate is going to be 6.5%. Now, if let's say what happens is the interest that you will pay, I repeat, the interest that you will be paying is going to be what? Is going to be 7.3% into how much are you borrowing? You're borrowing $4 million into $4 million into 6 upon 12. It's going to be 6.5% into $4 million into 6 upon 12. This is the interest that you would be paying. So you would have what? 4 million into 7.3% into 6 divided by 12. You end up getting what? 146,000 is the interest that you would pay to the bank. And in the second case, what would happen is you would have 4 million into 6.5% into 6 divided by 12. You end up paying $130,000 to the bank. Now what actually happens is you need to see the settlement under FRA. The settlement under FRA. The FRA that we have is 6.75%. So the settlement under FRA is going to be this is going to be 7.3% minus 6.75% into $4 million into 6 upon 12, and then 6.5% minus 6.75% into $4 million into 6 upon 12. So if you would actually look at the settlement under FRA, you would see that the settlement under the FRA is going to be 11,000. That is, we are going to be receiving 11,000 here. And in the other case, what is actually going to happen is you would actually be paying 5,000. So hence, resultingly, if we try to calculate the whole of it, I repeat, if we try to calculate the whole of it, it is going to be 135,000 here. And with respect to it, 146 minus 11, this is also going to be 135,000 that is going to be paid. So resultingly, what happens is, irrespective of whatever the interest rate that is going to be applicable upon your borrowing, I repeat, irrespective of whatever the interest rate that is going to be applicable upon your borrowing, your end result is going to be 135,000, 135,000. And if I try to calculate the effective rate achieved through this 135,000, the effective rate achieved through this 135,000 is going to be what? I would say 135,000 is the interest cost that we have achieved on a borrowing of 4 million. But since this cost was achieved for a period of 6 months, therefore we have to say multiply by 12 divided by 6 in order to annualize this cost. We need to say multiply by 12 divided by 6 in order to annualize this cost. So what is it going to be? 135,000 divided by 4 million multiply by 12 divided by 6, resultingly 6.75% is what we have achieved. So what has actually happened is, this is what happens under an FRA. Whenever you have got a forward rate agreement, this is something that happens, that your interest rate is fixed. You would either be paying, you would either be receiving, but end of the day, what is going to be done is that you would be achieving a fixed interest cost that is something that you would be achieving. Okay, so is this okay to everyone? Do you people get the calculations? Do you understand how we have calculated them? Well, Ibad Ali, which FRA rate is suitable for the company? It's not something that you decide. It's actually whatever that is available. Now, see what happened is you had the multiple FRAs available here in the market, but you would obviously be going for the FRA which is relevant for you. You would not be going for every single FRA that is available in the market. This was the only relevant FRA that was available, and this was the rate that was applicable. It's something that it's not your choice. Yeah, if you are being provided FRA by 2-3 different banks, then obviously you would go for you will go for a rate which is going to be the lowest possible rate. But what is important for me is that that you should understand that how we have performed the calculations for this FRA. Because if you understand these calculations, then that means you're getting to know the concept. Now, since you people have been able to understand this, I'm going to create a scenario for you people, which is going to be a case of a lender, and I would want you people to perform the calculations. So let's talk about it. Assume that the scenario for this specific lender is like this. I repeat, assume that the scenario is like this. You've got an entity plans to deposit dollar 2.5 million for a period of 5 months in 3 months time. Available FRAs are as under. So you've got 5 dash, you've got 3-5, you've got 5-8, you've got 3-8, you've got 3-9. The available FRAs, the rates that are available for the FRA are like this: 2.75% to 3%. The second FRA, the rate is available is 2.8% to 3.1%. Then you've got 2.9% to 3.3%. And then you've got 3.3% to 3.9%. The actual now required is you have to perform calculations if actual deposit is made at case number 1, 2.6%. Case number 2 is 3.05%. So I'm giving you people a period, 5 minutes time. What you could do is that you could try to attempt this question, and then we are going to start discussing. So you've got 5 minutes time to attempt this question. What you need to do is that you need to see it says an entity plans to deposit. What is it? An entity plans to deposit $2.5 million for a period of 5 months. What is the period for which you are going to be depositing it? It's going to be for a period of 5 months in 3 months time. So that is going to be in 3 months from now. In 3 months from now, you'll deposit this 2.5 million for a period of 5 months. That means it is going to be 8. That means it is going to be what? 8 months from now. So as I told you earlier, that always remember what happens is the way we go about is, I repeat, always remember what happens is the way we go about is we start from now and we say that when are going to be the transactions from now. So it's 3 months from now and 8 months from now. So the relevant FRA is going to be 3-8. And since you are a depositor, so that means the lower rate is going to be applicable. So it's going to be 3.8 FRA with a rate of 2.9%. That is something that you will be achieving. I repeat, it's going to be 3-8 FRA with a rate of 2.9%, that is what you will be achieving. Now let's just try to see that what is it actually going to be. So let me help you understand this. Basically what happens is, in case if the actual deposit is made at 2.6%, what is going to happen? If the actual deposit is made at if the actual deposit is made at this 3.05%, what is going to happen? Let's try to understand this. Now, the spot rate 2.6%, 3.05%. I repeat, the spot rate, which is what, 2.6% and 3.05%. Now what happens is, if the spot rate is like this, so the interest received is going to be what, 2.6% or 3.05% multiplied by $2.5 million multiplied by 5 divided by 12. So the amount of interest that is going to be received is going to be what, $2.5 million multiplied by 2.6% multiplied by 5 divided by 12 is going to be 2708.3 here. And in the other case, it's going to be what, 2.5 million multiplied by 3.05% multiplied by 5 divided by 12. So this is actually going to be 31770.83. So what is it? It's going to be 31770.83. Now what happens is, there is going to be a settlement under FRA. I repeat, there is going to be a settlement under FRA. Why? Because you are a lender. You are a lender. So if you are a lender, what is going to happen is 2.9% less 2.6% multiply by $2.5 million multiply by 5 divided by 12, and then it is going to be what, 3.05, sorry, again it's going to be 2.9% minus 3.05% multiply by $2.5 million multiply by 5 upon 12. So resultingly what is going to happen is that it's going to be 2.9 less 2.6 multiply by 2.5 million multiply by 5 divided by 12. This gives you what, 3125. Okay, so this is going to be 1562.5. So resultingly what is actually going to happen is that, if you could just see this, it's going to be 30,208.33, and this is also going to be 30,208.33. So this is what the calculations are going to be: 30,208.33, 30,208.33. And if we try to calculate the effective rate on the basis of this, so it's going to be 30,208.33 divided by 2.5 million and multiply by 12 divided by 5, because we have to annualize it. Why? Because we have to annualize it. So 2.899%, which is 2.9%. That's what the relevant result of this whole FRA is. I repeat, the result of this whole FRA is going to be 2.9%. Yes, this lecture is going to be shared. Okay, so this is what it is going to be. Okay. So I hope you people do understand this, right? So this is how the lender's FRA is going to operate. Okay then, so what I'm going to do is that I'm going to conclude my class of today here, and I'll continue further with the additional questions on FRA in my next session. But I hope that what has happened is you people would have understood how a borrower's FRA and how a lender's FRA is handled.